If you're a freelancer and you've ever opened a SEP IRA because someone told you it was the smart, simple move for self-employed people, I need you to watch this entire video because that one decision, the one that felt responsible and straightforward, might be quietly setting up one of the most expensive tax mistakes you can make, and almost nobody warns you about it until it's too late. Here's what we're actually covering today. You've probably heard that freelancers should open a SEP IRA, contribute as much as they can, and feel good about their retirement planning. That advice isn't completely wrong, but it leaves out a critical piece that can cost you $10,000 or more over time. I've gone deep on exactly how this plays out, and what I found is that the problem isn't random bad luck. It follows a very predictable pattern that hits freelancers specifically because of how their income and tax situation works. So we're going to walk through the mechanics of the trap, why it keeps happening, and what the better path actually looks like. Starting with something that sounds like a minor technical footnote but is genuinely one of the most expensive surprises in the whole retirement planning system. Let's talk about the pro-rata rule because this one flies completely under the radar, and it can quietly cost you tens of thousands of dollars without a single person warning you it's coming. Here's the setup. You're a freelancer, you've been doing well, and at some point your income climbs high enough that you can't contribute directly to a Roth IRA anymore. The IRS phases out direct Roth contributions once you hit a certain income threshold, around $161,000 for single filers in 2024. So your advisor tells you about the backdoor Roth strategy, which is the workaround high earners use. You contribute to a traditional IRA, then convert it to a Roth. Totally legal, widely used, and genuinely a great move, but only if your situation is set up correctly for it. Here's where it breaks for freelancers specifically. If you already have a SEP IRA, which is the account most advisors recommend for self-employed people, the IRS doesn't look at your account separately when you do that conversion. It pools all your pre-tax IRA money together and calculates the tax on a pro-rata basis. So say you have $93,000 sitting in a SEP IRA and you contribute $7,000 that you want to convert to a Roth. You might assume that $7,000 converts cleanly and tax-free. But the IRS sees a $100,000 total in IRA money, $93,000 of which is pre-tax, so 93% of your conversion is taxable income. You end up paying taxes on $6,510 of a $7,000 conversion you thought was going to cost you nothing. Do that a few years in a row and you've quietly handed the IRS thousands of dollars you didn't have to give them. And here's the thing. Most advisors recommend SEP IRAs because they're genuinely easy to set up. That part is true, but the pro-rata consequence is something they almost never bring up proactively. For a freelancer who earns too much for a direct Roth contribution, this isn't a minor footnote. It's a 10,000+ mistake that compounds over time as your SEP IRA balance grows, and every future conversion gets more and more polluted by pre-tax money. That's the trap itself, but the reason it keeps happening gets into something even more uncomfortable about how the advisory business actually works. Because the SEP IRA recommendation isn't just about simplicity, there's a financial incentive underneath it that most people never think to question. The better account for most freelancers is a solo 401k. It has higher contribution limits, more flexibility, and critically, it does not trigger the pro-rata problem we just talked about. When you do a backdoor Roth with a solo 401k in the picture instead of a SEP IRA, the IRS does not count 401k balances in that pro-rata calculation. So your conversion goes through cleanly. That's a fundamentally different outcome, and it matters a lot over a long time horizon. But setting up a solo 401k is more involved. You typically need a third-party administrator, a record keeper, and coordination with your CPA. It takes more work and more time to establish than a SEP IRA. And here's the thing, that extra complexity doesn't generate more revenue for your advisor. In a lot of cases, it actually creates more work for them with no additional upside on their end. So the recommendation defaults to what's easier for the advisor to set up, not what's better for your long-term tax situation. That's not a conspiracy. It's just a conflict of interest that's been baked into the business model for decades. And once you understand it, you start to see it showing up everywhere. The AUM model, which stands for Assets Under Management, is how most financial advisors charge fees. They take roughly 1% of whatever money they're managing for you every single year. On the surface, that sounds reasonable. But think about what that actually incentivizes. An AUM advisor only gets paid on money they control. They don't earn anything on the money sitting in a solo 401k that you manage yourself. So if you ask your advisor whether you should roll an old retirement account into your new employer's 401k or into an IRA they manage, they're almost always going to say put it in the IRA because they can charge 1% on an IRA. They can't do that with a 401k sitting outside their platform. For freelancers, this gets even more pointed. The more you contribute to a well-structured solo 401k, the less money flows into accounts your advisor can charge AUM on. Every dollar you put into that account is a dollar that doesn't generate revenue for them. So there's a quiet disincentive to help you maximize it, even though maximizing it is almost always the right move for your taxes. And on top of that, freelancers create a problem that AUM advisors genuinely don't love dealing with: income volatility. About 40% of the current U.S. workforce is made up of contingent workers, and that number keeps growing. But for an AUM advisor, a client whose income swings from $150,000 one year to $40,000, the next is a forecasting headache. The assets under management fluctuate, the revenue is unpredictable, and the client needs more attention than a W-2 employee with a steady paycheck and a simple tax situation. Traditional clients are just easier to manage from a business perspective, so freelancers get deprioritized, not because advisors dislike you, but because your income structure makes you a harder account to run profitably. You're what the industry calls high touch, low AUM, more work, less money. That's not a combination that gets you the best advice. Now, if you're finding this useful, do me a favor and hit subscribe, because the next video in this series goes even deeper into the tax strategies that advisors almost never bring up with freelancers, stuff like the QBI deduction and the S-Corp election. Those are moves that can save you real money but generate almost no revenue for the advisory industry, which is exactly why they don't come up in most advisor meetings. You won't want to miss that one. But back to the core problem here, because there's one more layer worth understanding before we wrap up. The issue isn't just that the SEP IRA creates a pro-rata problem. The deeper issue is that freelancers are consistently being pushed into financial systems that were designed for people with steady W-2 paychecks, predictable annual incomes, and simple retirement planning needs. When your income changes month to month, when you pay your own self-employment tax, when you're handling quarterly estimates, and when your retirement contributions have to work around your business cash flow, generic advice doesn't just fall short, it can actively cost you money. Think about the full picture here. You open a SEP IRA because it's simple and your advisor recommended it. Your balance grows over a few years. Then your income crosses the Roth contribution threshold and you want to start doing backdoor Roth conversions. Now you're stuck. Every conversion you make is partially taxable because of that SEP IRA balance sitting there. You either pay the taxes you didn't plan for, or you stop doing backdoor Roth conversions entirely and lose out on years of tax-free growth. Neither option is great, and both of them were avoidable from the beginning with the right account structure. The solo 401k doesn't have this problem. You can contribute more to it in most cases, up to $69,000 in 2024 if you're under 50, compared to 25% of net self-employment income for a SEP IRA. You can make Roth contributions directly inside a solo 401k if your plan allows it. And because the IRS excludes 401k balances from the pro-rata calculation, your backdoor Roth strategy works the way it's supposed to. The solo 401k is more work to set up, but the tax flexibility it gives you over a 20 or 30-year career is worth a significant amount of money. So here's where we land. The SEP IRA isn't a bad account in a vacuum, but for a freelancer who earns enough to want a backdoor Roth, it can quietly block one of the best tax strategies available to high earners. And the reason it gets recommended anyway comes down to a combination of simplicity and a business model that doesn't always reward advisors for doing the harder, more customized work. What started this video as a simple account recommendation, open a SEP IRA, it's easy, turns out to be a decision with real downstream consequences that most people don't discover until they're already in the middle of the problem. The pro-rata rule, the backdoor Roth complications, the AUM conflict of interest, none of these are secrets. They're just things that don't come up in a standard advisor meeting because the standard advisor meeting wasn't built with you in mind. So before you open a SEP IRA, before you roll money into an account just because someone can manage it for you, and before you assume the advice you're getting is optimized for your actual situation, slow down and ask better questions. Ask what happens to your backdoor Roth strategy if you open this account. Ask whether the pro-rata rule applies to you. Ask why a SEP IRA is being recommended instead of a solo 401k. Ask how the advisor gets paid, and ask whether this advice was actually built for a freelancer or whether it's just standard retirement advice with your name placed on top. Those questions will tell you a lot about whether you're getting the right guidance or just the easiest guidance. If this gave you a clearer picture of what's actually happening inside these recommendations, drop a comment below and let me know. Specifically, has anyone ever explained the pro-rata rule to you before? I'm genuinely curious how many people are sitting on SEP IRAs right now without realizing this is an issue, and if you know a freelancer who opened a SEP IRA without thinking through the Roth implications, share this with them. It's one of those things that's a lot easier to fix before it becomes a problem than after. The next video goes into the strategies that advisors almost never bring up with self-employed clients, the QBI deduction, the S-Corp election, and why some of the best financial moves for freelancers happen completely outside a traditional advisor relationship. That one's worth watching if this one resonated with you. This video is for educational purposes only and is not personal financial, tax, or investment advice. Talk to a qualified CPA or financial professional before making any decisions based on your own situation.